All and everyone, welcome back to my third episode following my dividend investment account. As we can see right now, the account is doing much better than it was before. So overall, we're at £3,124 roughly in the account. We've got £3,083.66 that have been invested, nearly £30 waiting to go in, and then £11 standing over. The account has done so much better this month than it had the prior. As you can remember, it was something like 5 or 6% down because of how volatile the market was. The American banks were struggling, and that had an effect on the British market. Luckily, the British market has stabilised, and it looks like the American market has as well. But one of the reasons the account is doing well is because I've changed how I've been investing. As I scroll down here, I'll quickly show you some of the shares. I sold my Admiral shares for something like £45-50 profit, which was a very quick turnaround, so I was happy to take that. I have been offloading my American shares once they hit net neutral, which is how I'm going to do, because I think all of these shares that I've got are eventually going to make profit. One thing that I hadn't factored in when I was investing in American shares, and this is my fault for overlooking, was that the FX impact was going to be so detrimental to returns. So even here, Stanley Black & Decker, it says it's negative £7.30, but actually the shares are in profit, and that's due to the FX impact. So because of that, and because of the small dividend tax you pay in the UK, I have been focusing mainly on British shares. And I'm very happy to see that some of them are in the red, because at one point every British share I had was in the green. And I was quite worried about that, because I thought, well, all the shares I want to invest in right now, I have investments in. So it meant I had to look around for a few more, and there wasn't any in the market at a price I like. But luckily some have went down again. So Rio Tinto, although I do expect it to fall further, I think that's at a good buying price right now. The Works, to me, I love the Works. I'm a book hoarder, and the Works sell a lot of books. So as you can see, I'm trying to buy more into the market, but it's just not trading. It's got a 2.2 PE ratio. It's a remarkable store, and I can't see anywhere that it might be falling. So to me, that's something that people should be buying in. Of course, that's just my opinion. I was lucky in that Royal Mail, which is international services, they have negotiated their pay now, so that meant the stock went up. I think it's going to keep going up, so I don't know if I'll keep investing just to get more money into it. But 8% return on that, that's very good. For Expo, that's another quick one. So this is the mining company situated out in Ukraine. So due to the conflict over there, the PE ratio is only 2. It's still somehow managed to make a profit. So when you look down here, you can see the revenue and net income has fallen as you'd expect. It went from COVID to then this. It's still making a profit, which is remarkable. And to me, that shows that the management is doing an excellent job, and that once the conflict has been resolved, the shares are just going to go straight up. And it does predominantly iron pellets. And iron pellets are never going to go out of requirement. We need steel. As much as we go on about all the green commerce, we need iron. So for Expo, in the long run, I think that's going to be fantastic. There's quite a lot here that I'm going to keep investing in. British American Tobacco, right now, I think that's a good price still. So I'm going to be putting more in there. They have a really nice dividend yield. So as you can see, the account is doing well. I'm much happier with where we are now. We are currently negative 0.87%, which to me is nothing. It could be plus 0.87%. I wouldn't particularly care. What I do want in the long run is for the dividends to outperform the negative, because I see it going down because of the markets. But let's get on to the dividends, actually. I nearly forgot. So we're into the month of April have just gone. The first dividends I got there were Tritax Big Box REIT, and that was for 88 pence on the 3rd of April. And then Vanguard FTSE Emerging Markets was 8 pence. That was followed by on the 4th, Barclays for £2.18. And then Medical Properties Trust for £5.84. So overall, that's £9 roughly, which is fantastic. I'm very happy with that. The dividends are growing. As you can see down here, I've been investing more into the Vanguard market. So we've got about £280 now in the alternative FTSEs. So we've got FTSE 100, FTSE Emerging Markets. We should have the FTSE 500. Oh, that was it. Yeah, S&P 500 and All World. which to me right now look like a good investment. I'm hoping to have roughly 10-15%, maximum 20 in the long run. It depends how well I'm doing. But yeah, that's just a quick update. I might start putting a bit more effort into these videos because I'm going to get a laptop or computer. Right now I'm just doing it all on my phone. But I am investing more than I was before. I've been making an analysis tool, which I'm going to be using to invest in the future. So once I've mastered that, then hopefully the returns are going to come back even higher. But we shall see. So good luck everyone, happy investing, and I hope to see you in the future. Have a nice day.